So, welcome to today's presentation. My name is Peter Yusuf, Senior Market Analyst at IronFX. We're going to be mixing technicals with fundamentals, and I intend to focus practically on 6 trading instruments. I will be picking A, Euro USD, B, USD JPY, C, the Aussie against the US dollar. WTI's price action would be also be going through. Gold, and most probably Nasdaq. Anything from the US stock markets, we'll check which one. Now, starting with Euro USD, this is the daily chart. Now, if we drill to the 1 hour chart, we should be able to see an upward movement characterizing with higher peaks and higher lows. In a similar sense like this, there was a false break here. And an even wider intensification. However, I think that what could be most accurately described as an upward trend line would be something like this. Shift it a little bit to the right here. And you can see how the pair is forming 1, 2, 3 lower lows, and we have 1, 2, 3 higher peaks. So there's an upward trend line which has been ongoing since the 29th of October. That's practically for the past 2 days. Back to the daily chart. It's a little bit intense. Could go a little bit to the right. Now, the movement is clearly bullish for the past, I would say, 2 days and during today's Asian and early European session, and is pushing still upwards. I have some reservations though, and those reservations are related to the RSI indicator, which is moving upwards, but has not still even reached the reading of 50, implying some stabilization, far less a bullish outlook. So I would be advising a bullish outlook. However, that's being done with substantial hesitation here. For the bullish outlook to emerge, in my opinion, we would have to, or would require the pair to breach the 1.0885 resistance line, the R1, while even higher, we note the 1.0950, and higher than that, we have the 1.01005. Now that could be drawn to 1.010, be my guess. On a fundamental level, let's start with the US dollar. And we had some conflicting messages yesterday from the USD. And I would be highlighting that we had the US GDP rate advanced, which that was for Q3, and it slowed down. It slowed down from 3% practically year on year to 2.8% year on year. The release as such, on the one hand, definitely the slowdown may have disappointed somewhat. On the flip side, though, 2.8% is actually pretty healthy under the circumstances, and if we compare it to growth indicators in the UK, Japan, and the Euro area. So that was one element which, in my opinion, was rather mixed. The next element on a macroeconomic level was a little bit more encouraging, and that was the release of the ADP national employment figure. It was for October. It's the first employment market metric for the current month in a whole. Now the indicator's reading rose substantially, over 220K. And in my opinion, that tends to highlight the upside possibility for the US employment market. Now, the release tended to gain specific attention or more attention as we have the release of the US employment report for October on Friday. Special focus being on the NFP figure. The NFP figure is expected to drop practically half of September's reading. On the flip side, though, the unemployment rate is expected to remain unchanged, as is expected to remain unchanged also the average earnings growth rate. So once again, we expect or we see the case for the market being positioning itself, taking a more cautious approach before the release as such on Friday, tomorrow. Other than that, I would be noting also on a fundamental level the US elections. Now, uncertainty remains high. The two candidates, we're talking about Donald Trump and Kamala Harris, are practically neck on neck. Even the difference in the swing states remains within the boundaries of a statistical error, either if the lead is for Harris or for Trump. So that's another issue which should be taken account for, and the stakes are high. Yet I would be noting here that markets seem to be increasingly convinced that Trump will be getting elected. Hence, we may be seeing, I would say, after the release of the US employment report for October on Friday, to see the Trump trade getting some traction. It's going to be quite interesting to see how that plays out. By the way, for the US elections, we are going to be making a couple of lives at this time. Instead of the usual presentation, we are going to be discussing, if I'm correct, on Tuesday about the US elections on the day. And we are going to be discussing also on Thursday about the result of the US elections and ahead of the Fed's interest rate decision in the American session on Thursday. Now, for the euro side of the pair, fundamentals, I would say not fundamentals, macroeconomics, yesterday and during today's European session were pretty good. We had two fields of economics which stood out. The one would be growth, the second would be inflation. Growth in the euro area seems to be picking up. And I would be highlighting here the preliminary GDP rate for quarter 3 of Germany, which accelerated, practically escaped negative territory, and thus avoided a technical recession, because should it have 2 consecutive quarters of negative growth, that would imply practically a recession. That was not the case. And in my opinion, that was quite a surprise for the German economy, a positive surprise. The second field would be inflation, and we had the preliminary HICP rate of Germany yesterday. The German HICP rate for October, it was on a preliminary basis, accelerated beyond expectations, which more or less moderated market expectations, dovish expectations for the ECB. I would also be noting France's preliminary HICP rate for October, which was released during today's European session, early European session. It also accelerated, not much, but nevertheless still accelerated, showing a persistence of inflationary pressures. And we should have gotten already by now, 15 minutes ago, also Eurozone's preliminary HICP rate. Let me have a look. And that would be going to have to drill into today's releases. Yeah, the French HICP rate accelerated from 1.4 to 1.5, practically ticking up as expected. That was okay. And you have Eurozones as a whole CPI rate, the HICP rate, which accelerated from 1.7% to 2%. It was expected to rise, but to reach only 1.9%. It was beyond market expectations even slightly. That was something which was expected in my opinion, and we may have a look at if it provided some support for the euro as such. This is the minute chart, and we can see how the pair was stable practically from quarter to quarter 10 GMT plus 3 up until that was 11:40, started to rise in anticipation of the acceleration and peaked at 12 o'clock. Allowing the release allowed practically the pair to rise even further, implying more strengthening on the euro side of the pair. Okay, that was interesting. So more or less we may see once again the dovish expectations of the market for the ECB being moderated. I would be highlighting here that ECB President Christine Lagarde, in the press conference following the last interest rate decision of the ECB, had highlighted exactly this scenario, that inflation in the area would be picking up in the last months of the year. And she also highlighted the anemic growth of the area. So practically we are in line, and in my opinion that may, I wouldn't say force, but solidify opinions within the ECB to continue cutting rates, yes, but at 25 basis points at a time, no more. Let's have a look now at USD/JPY. USD/JPY, which is strengthening against, practically, my mistake, JPY is strengthening against the US dollar, causing USD/JPY to drop. And I would be highlighting here this, in my opinion, it's not a result of USD weakening, it's a result mostly of JPY strengthening. I know that a number of analysts in the late Asian session today had highlighted that the drop of USD/JPY may be a result of USD weakening rather than JPY strengthening. But if you look, then you'll see that the JPY is strengthening not only against the US dollar, but also against the pound and the euro. So practically, I wouldn't say it's across the board, but there is a wider strength on behalf of the Japanese currency. And that's a result, in my opinion, from the release of BOJ's interest rate decision. Today, the bank, as expected, remained on hold, keeping rates at 0.25%. That was widely expected. The interesting element may have been the forward guidance. You can skip the accompanying statement. The accompanying statement was very laconic, very short. It was only a sentence. I think that BOJ's intentions was better described in another document which was also released today after the interest rate decision, and that was the outlook of the bank for the Japanese economy. In the outlook, the bank describes how uncertainties unfold on an international level and highlights that the Japanese have to focus on the US economy as well, which is for the time being strong, but it's interesting. And at the same time also highlights a persistence of inflationary pressures at 2.5% for the current year and 2% for the following 2 years. BOJ in its outlook also mentioned that should its expectations be realized, they're going to continue hiking. And in my opinion, the release as such highlighted the independence of BOJ despite the political uncertainty and turmoil which was created in Japan by the results of the recent elections over the past weekend. I would also note a second element which could have provided support for the JPY, and that would be that do not be fooled, Japanese officials are still keeping a close eye on unexpected moves in the FX market, especially of speculative nature. So that warning was reiterated also by Japanese finance minister practically on Tuesday, if I'm correct. And in my opinion, is a warning for cultures not to reach over the hand. So the possibility of another market intervention is also present. And last but not least, despite financial data not being of such an importance for JPY traders, they usually tend to bypass them. I would note that from Japan today we got a number of indicators which were not so positive. We had the industrial production growth rate which decreased, and at the same time I would be also noting that the retail sales growth rate decreased. They didn't just slow down, they went into the negatives. And on a macroeconomic level, that tends to imply that both the supply side and the demand side of the Japanese economy are weakening for September. It's definitely not a positive sign. Okay. On a technical level, given that the price action and its correction lower has breached the upward trend line, we initially, and I'm highlighting this word initially, switch our bullish outlook in favor of a sideways movement bias. Practically, we would maintain a wait and see position here. And I'm highlighting this because the RSI indicator, despite correcting lower, substantially lower, it has abandoned the heights of the reading of 70. Should be at 62 right now. Let's have a look. Yeah, 63. Tends to imply that there is still a residue of a bullish sentiment left within market participants for the pair. So we may see that actually slowing down the bears or even forcing the pair to go upwards again. Best case scenario for the USD/JPY bulls would be for the pair to drop, bounce on the S152 support line, and then readjust, the bulls take over, and the pair starts aiming for the 154.80 resistance line. And that would allow us to shift the upward trend line to the right and at the same time form a new higher trough and possibly a new higher high. But for the bullish outlook to re-emerge, in my opinion, the R1 has to be broken. I would require a little bit more conclusive evidence. I know it sounds conservative. That's my style. Okay. Let's have a look at the Aussie. Now, AUD USD seems to be balancing out on the 0.6570 support line. It's about to be broken, but has not been broken yet. On the wider picture, though, in my opinion, the downward motion, despite being interrupted, still maintains its momentum. It's characteristic that the downward trend line guiding the pair lower is intact. The pair has not even tested the downward trend line, so the bearish outlook remains. The RSI indicator has edged a little bit higher from the reading of 30, but it's immaterial. The bearish tendencies of the market for the pair are still there. And on a technical level, we tend to maintain our bearish outlook. Expect the price action to break clearly the S1 0.6570, form a lower true than this one, and actually start aiming for the S2 0.6470. On a fundamental level, we had a number of releases today during the Asian session, which were quite interesting for Aussie traders. The first was the release of the building approvals growth rate. It was for September. Now, the building approvals growth rate accelerated. It actually escaped negatives and rose to reach, if I'm correct, 4.4%. That should be month on month. It was a very wide acceleration. And that tends to be positive news or innuendo for high economic activity in Australia's construction sector. On the flip side, the retail sales growth rate for the same month slowed down beyond expectations, almost reaching stagnation levels at 0%, but it didn't do it at 0.1% month on month. Definitely this slowdown of the retail sales growth rate tends to imply that there is a relative unwillingness, or could also be that Australian consumers are unable to increase their spending in the Australian economy. And that's definitely not positive news for the Aussie. So we see that practically the Aussie was confined within these conflicting news. We had, though, also news from China. And the news were quite promising. We had the NBS manufacturing PMI figure for October, and we had also the services PMI figure for the same month, both from the National Bureau of Statistics of China. Both indicators were above the reading of 50, as did naturally the composite one, implying expansion of economic activity, even a slight one. Now, that tends to be a little bit optimistic, in the sense that we still have to get the Gaixing PMI figure for the same month, which is due out during tomorrow's Asian session, to confirm the expansionary nature of the economic activity in the manufacturing sector of China in the current month. For Aussie traders, though, I would be also highlighting Q3's PPI rates. Inflation is a big issue, and inflationary pressures at the producers level tend to be rolled over to the consumer at a later stage. So the PPI rate could serve as a qualitative measure of inflation in Australia over the past month. And we're talking about September here. Should we see an acceleration of the PPI rates, we may see they're also getting some support. On the flip side, should the rates slow down, we may see the Aussie slipping. Let's have a look at WTI. We're adjusting the chart. Let me reposition the labels. So we saw oil prices getting some support yesterday. Oil bulls seem to be wobbling today. There is a downward trend line here, which should be noted, by the way. It is. You can see how the pair is forming lower peaks. Sorry, the commodities price is forming lower peaks and lower troughs. 1, 2, 3, 1, 2, 3. The RSI indicator is below the reading of 50, slightly. It's at 42 if I'm correct. Let's have a look. 44, 45. A bearish outlook is possible here. On a fundamental level, though, we may be seeing some bullish signals. And I would be noting three possible signals which could be pointing towards a bullish potential for oil prices. The first would be the release of the EIA crude oil inventories figure yesterday. Now, EIA reported a drawdown in US oil inventories that corroborated practically AP's release the day before, Tuesday. And overall, both indicators tended to imply a possible tightening of the US oil market, as practically production levels were not able to catch up with demand, and that forced US oil inventories to drop. So a tight US oil market could be providing some support for oil prices. That's one. The second issue would be the report by Reuters today that OPEC may delay the oil production hikes beyond December. It was deeply expected that OPEC in its December meeting would practically allow member states to produce more oil, and that would more or less enhance or strengthen the supply lines of the international oil market, which could cause oil prices to fall. The delaying, though, of such an oil production hike could be straining the supply lines of the international oil market, and thus could be a boost for oil prices. And the third element I would be noting is that increased economic activity in the manufacturing sectors of China and the US could potentially imply a stronger demand outlook than expected for oil, and in such case exercise some bullish pressures on oil prices. We had already the NBS manufacturing PMI figure for October, which was better than expected from China. That was one indication. Tomorrow we're getting also China's Caixin manufacturing PMI figure for October. And I would be also highlighting, after the release of the US employment report for October in the American session, the release from the US of the ISM manufacturing PMI figure. It's also for October. And should we see the Caixin PMI figure and the ISM manufacturing PMI figure showing increased economic activity, that could imply increased demand for oil as well, boosting its prices. On a technical level, though, I have to note it here, we're still on a bearish outlook. For a bullish outlook, I would require the commodity's price to breach the pre-mentioned downward trend line, breach also the R1 71.40, and start aiming for the R2 77.85. On the flip side, should the bears maintain control or regain control, we may see the commodity's price forming a lower trough than this one. So practically they would have to breach the S1 64.60 with the next possible target for the bears being the 57.15. Okay, let's have a look at gold. Gold, which is correcting lower during today's Asian and early European session, but the bullish outlook is still present, no question about it. The negative correlation of gold with the US dollar, in my opinion, is not working right now. I think gold bulls are feeding from the uncertainty in the markets. And it's characteristic that despite US yields rising, US bonds were not able to pose as a credible competitor for gold, despite bearish interest. And that's how strong the demand for gold right now is. I'm maintaining my bullish outlook, albeit I have to note here that the correction lower is very possible for the precious metals price. It's characteristic that the RSI indicator is at the reading of 70, implying more or less, or highlighting if you prefer, a strong bullish sentiment among market participants for the precious metal, but at the same time it may be also implying that gold's price has reached overbought levels and is exactly ripe for such a correction lower. But as long as the correction lower remains above the upward trend line, we maintain our bullish outlook. In such a case, we may see gold's price aiming of not reaching, if not breaching, the R1 2830. On the flip side, should the bears take over, a bearish scenario right now seems very remote, because exactly the bar is very high for a bearish outlook to be materialized right now. For such an outlook, I would require practically gold's price to breach the S1 2785, which used to be the previous record high, drop further, breach the pre-mentioned upward trend line, breach the S2 2685, and aim, if not breach, actually also the S3 2620. It's a long way down for bearish outlook, and I think it's going to be difficult for gold's price to achieve that correction and turn it exactly into a bearish outlook. Now, I know we had discussed about seeing Nasdaq, or I told you that we would be seeing Nasdaq. Allow me to switch Nasdaq for Microsoft. Okay, Microsoft price yesterday initially rose. Let's have a look at that. Yeah, that was yesterday's movement. It opened with a negative gap, and if we drill into the 1 hour chart, we should be able to see that. Yup. No, it didn't. It rose. Okay. There was a positive gap, as you can see it here. See how the price action of the shares price ended at this level at 433. Sorry, 431.83, and it opened yesterday this high at 437.44. So practically we're talking about $4 gap. And I think that was understandable in the sense that the market was increasingly expecting Microsoft's earnings report to actually surpass Wall Street predictions, and it did. But note how the price action of Microsoft fell yesterday, and that continued to fall practically, or is expected to continue to fall today as well. Why? Because Microsoft, like Meta, reported better than expected EPS and revenue figures. Okay, that was a positive. But in the earnings report, they also mentioned that there will be increased investment in AI. And we're talking about AI infrastructure here. It's an issue which tends to worry the markets. And let me explain why here. When we're talking about investing in AI infrastructure, we're talking about practically investing capacity. And capacity becomes more and more expensive, and at the same time more and more needed. The problem is that capacity is defined also by microchips, and there the market hits a bottleneck. Nvidia, for example, is already working at full capacity, maybe lagging behind in orders. Prices are rising, and the race for AI domination is intensifying, in my opinion, day by day. So we may see mega cap companies like Microsoft, like Meta, like Google, Alphabet, being forced to actually invest in AI in order to dominate the field. But exactly this race is forcing them to spend more and more and more on projects which may be somewhat uncertain. And that tends to intensify market worries about the profitability margin of these mega cap companies. I wouldn't be surprised if even, say for example, today in the aftermarket hours, we're getting the earnings reports of Amazon and Apple, another two mega cap companies. And I wouldn't be surprised to see the price action falling exactly on such extensive worries. On a technical level, I would maintain a bullish outlook for the time being. But frankly, I would expect the technicals to be broken by fundamentals in today's American session. It's a wait and see position, I know it, but it's quite interesting how this thing will develop. Could even lead to a negative spiral. That should sum it up for the day. From all of us here at IronFX, best wishes for solid trading, and be on your watch out. Keep your guards up for tomorrow's US employment report.
Okay, I'm gonna go ahead and get started. Okay, so welcome to today's webinar. As per usual, a risk warning and disclaimer before we get started. Our products are traded on margin and carry a high level of risk, and it is possible to lose all your capital. These products may not be suitable for everyone, and you should ensure that you understand the risk involved. A disclaimer, the information in this webinar should not be considered investment advice or an investment recommendation, but instead educational material only. The material is just the personal opinion of the author, and the client's investment objectives and risk tolerance have not been considered. IronFX is not responsible for any loss arising from any information contained herein, and redistribution of the material is strictly prohibited. Okay, so I'm Melanie and I'll be your speaker for today. I'm an investment analyst from Rocket, who are finalists for Best FX and Equity Research in the years 2019 to 2021. So here's our agenda for today. We're going to start off by looking at how exactly you can trade a breakout by looking at price action. And then we'll look at some candlestick breakout patterns, followed by pullback, support and resistance for bullish as well as bearish breakouts. And then we'll look at correlation, followed by multi-step stop loss and picking your entry and take profit. Okay, let's go ahead and get started. So here's our price action trading approach. Firstly, let's talk about reversal and then we'll talk about breakout. So why is it not? Okay, so this is basically the reversal. The reversal occurs at the edge of our channel, right? So you can see price bouncing off of that channel. Here, price is moving in an ascending trend channel. So you can see price recently reversed off of that, the top of the channel. And then we see this morning star formation forming here. And if you're not familiar with candlestick patterns, not to worry, I will go through some of the formations, top used formations in the next couple of slides. But here we have a morning star formation giving us a reversal pattern. Okay, and then price then breaks above this what we call an overlap level. Overlap basically means that there are swing highs as well as swing lows that line up in that same area. Okay, so with price lining up, price breaking out of that overlap area, we see that bounce over here and it breaks out of this area here. Okay, so the breakout now happens out of this resistance area. Okay, so as I mentioned earlier, overlap occurs when you have swing highs and swing lows that line up. So we have two swing highs and one swing low here. So we're looking for this resistance area to break out of. And you can see there is this formation here as well. I'll go through this in a bit. And this is called the three white soldiers, and you can see price breaking out of it. So the three white soldiers basically means that it gives us a signal that prices are going to continue in this uptrend. Okay, so it's breaking out of that level and we expect it to continue, which it did here. Okay. Okay, so now let's talk a bit about the anatomy of candlestick, and we'll briefly go through the different breakout strategies for candlesticks in a little bit. So you can see this is the anatomy of a bullish and bearish candle. Starting off with bullish, we have the high price, close price at the upper wick, and the body, followed by the body, and then the open price and the low price. Whereas for bearish candle would just be the opposite. So starting with high price again, the open price occurs at the start of the top of the body, and close price occurs at the bottom since we are going in a downtrend. So the open price would be here, close price here, and then your low price is just the tail of the candlestick. Okay, so let's start off with our top three candlestick patterns. Okay, let's firstly look at the hanging man. Excuse me. So with our hanging man, you can see prices are just moving downwards at the start. Um, okay, starting off with hammer, we'll get into hanging man in a bit. Hammer's just, we're just looking at this one candlestick here. So it's a shorter upper wick, followed by a small body, and then a long bottom wick. The hanging man would just be the opposite of that. So these kind of tell us that we can expect a reversal in price. So here for the hammer, prices are moving in a downtrend. Once we see this hammer, it's a indication that prices are going to reverse and head upwards. Hanging man would just be the opposite of that. Okay, next we're looking at inverted hammer and a shooting star. So again, these two are signals that prices are going to reverse off of whatever these levels are. Normally, prices will reverse off of pullback levels, so your support levels or your overlap levels that we went through earlier. And I'll go through a couple of pullback levels as well in the coming slides. But basically, inverted hammer occurs when prices are moving in a downtrend, and then we see this and we're expecting a reversal to an uptrend. Shooting star occurs in an uptrend. Once we see this, we're expecting prices to go in a downtrend. So pretty straightforward so far. It's more about being able to identify these candlestick shapes. And the last single candlestick pattern that we have are the doji candlestick patterns. Okay. So for our dragonfly doji, it's a sign that prices again are going to reverse. But instead of having our usual body of a candlestick, we are greeted by this T kind of shape. Oop. So if we go back, you can see in our previous two slides, we see this very small Hammond's candlestick shape. Here instead, we see this T shape, followed by the gravestone doji, which is just the opposite, prices moving in an uptrend. Once you see this, we're expecting prices to move in a downtrend. Okay, so the reason for this kind of doji candlestick shape is because it forms when the open and the close price are equal or very close to equal. So that's why we don't see this body candle of the candlestick shape forming. So it's typically considered a neutral formation, suggesting that there's kind of an indecision between buyers and sellers. Of course, here we're seeing a bearish bias. Here we're seeing more of a bullish bias, but depends on the price swing and the general trend as well. So all of these three candlestick patterns that we've gone through so far give us a reversal candlestick pattern. Okay, now let's move on. I'm gonna look at the um oop, yeah, the next double candlestick patterns. So for these two, they're going to be two candlesticks instead of one. So here we have the bullish engulfing and bearish engulfing candle. Okay, so bullish engulfing basically is a sign that prices, you can see this red first, means that prices are moving upwards. The open is here, close here. So our bullish candlestick that follows that basically closes above the previous candle's open. So previous candle's open is here, bullish candle's open would be higher. And the length of the candlestick should be engulfing or rather longer than the previous candlestick. That's why we call it engulfing. Okay, so it engulfs the previous red candle. Bullish candle then opens at or lower than the previous candlestick's close. Okay, oop. If we look at the bearish engulfing, you can see that the shape is kind of similar. Prices, again, your open is here. or rather, I guess here would be your close and open here, but it's kind of the same concept. So your open would just be here, or rather here. Okay, so it opens either at or above the previous candle's open, and it will close lower than the previous candle. Okay, so the main feature of this candlestick pattern is that the second candlestick's body just has to be longer than the first, and that's why we call it engulfing. Okay, both of these signals are more likely to signal reversals when they are preceded by four or more candlesticks. And we'll show you some examples in a bit as well. Okay, let's move on. So the next is our tweezers. So for tweezers, you can see it's a repeated shape. Basically, there are no upper wicks for both of the candlesticks. For tweezer bottoms, prices are moving downwards, and this signal is a sign that prices are going to reverse into an uptrend. Then the opposite would just be tweezer tops, in which prices are moving in an uptrend, and when you see this kind of candlestick pattern, it's a sign prices are going to reverse into a downtrend. Okay, I think these are pretty straightforward, and these candlestick patterns can often be found with an established support or resistance from your previous price movements. Okay, let's move on. Now we're gonna look at the top three triple candlestick patterns. Okay, starting off, we have our morning star, morning star and evening star shape. Okay, so starting off with morning star, you can see prices are moving in a downtrend. It starts off with a large bearish candle, followed by a smaller bullish or bearish candle. So this doesn't have to be bullish, it can be bearish as well. And then last point would be a large bullish candle. Okay, and then we are expecting a subsequent bullish price action. Okay, of course, the opposite would happen for our evening star. Prices are moving in an uptrend first. It's made out of a long bullish candlestick, a smaller bullish or bearish candlestick, and subsequently a long bearish candlestick. And then we see a bearish price movement subsequently. Okay, so one of the limitations of this candlestick pattern is probably it's quite risky because it's not really backed up by volume or some other indicators. So for example, previously I was talking about how the tweezer candlestick patterns are quite often accompanied by support and resistance levels. That's from previous price movements. So for this candlestick pattern, if you're just looking at it on its own, it might not be a very reliable signal. So normally with these candlestick patterns, we would use some other indicator as well. So if you're able to find support and resistance levels, that's great. But if not, we would use RSI as well to determine if prices are currently oversold, for example. So if it's oversold and we're looking at a morning star, then you know you have confluence and confirmation prices are gonna reverse and move in an uptrend. Okay, and of course that would be the opposite for evening star. Okay, next, let's look at our next candlestick pattern. We have the three black crows and the three white soldiers. So for these candlestick patterns, you can see it's pretty straightforward. It's just basically a continuation of um, whatever the trend is. Okay, so if we look at the three white soldiers that we saw earlier, prices were already moving in an uptrend. And let me go back to the example at the start. Mm, okay, so here we saw the morning star formation, which I'll get through, which we saw earlier, and then prices moving upwards. The three white soldiers, okay, you can see this formation happening here. So it's not really a sign of reversal, it's more of a sign of continuation, or if prices are breaking above a specific resistance level or support level, that's also a signal for breakout. Okay, so here's the three white soldiers, and we subsequently saw prices breaking out above the resistance level. Okay, so I think it's pretty straightforward. The candlestick patterns are just basically three consecutive bearish or long bearish or bullish candles, depending on the three black crows or three white soldiers. Okay. Lastly, our top three triple candlestick patterns are the three inside up and the three inside down. For this, we're basically looking at um a double candlestick here. The main point would be that the bottom of the candlestick should line up with the previous candlestick. And the second candlestick should also be shorter than the first. Okay, and that's the same for inside down as well. Okay, these are also reversal candlestick patterns. So you can see prices are moving in a downtrend. Once you see this candlestick formation, we are expecting prices to reverse into an uptrend. And similarly for three inside down, uptrend into a downtrend. Okay, so this basically shows that this current trend, so if it's a bearish trend, it's basically a sign that your trend has lost momentum, and so a move in the other direction might be showing. So that's for three inside down. If it's a bullish momentum, it's kind of losing that uptrend and then moving into a downtrend. Okay, so these work better in a trend, so a specific trend, and it's not so good in markets that are moving sideways. Okay, let's move on to the top three reversal patterns. So firstly, we have the head and shoulders top. You can see the pattern basically starts off with a left shoulder, a head, and a right shoulder. So the swing high is over here. And this trend basically signals a bullish to bearish trend reversal. So prices are hitting break out of this neckline and heading towards our target over here. Okay, so the neckline basically occurs when you connect the bottom of that reversal from the left shoulder and from the head. When you connect that, that's your neckline. Oops. Okay. Okay, so this pattern is actually considered one of the most reliable trend reversal patterns, and it's one of several top patterns that signal with varying degrees of accuracy that an upward trend is nearing its end. So we see prices making higher highs and higher lows, as you can see from this trend line here. Once it breaks out of that trend line, then you have kind of downward confirmation that prices are going to continue to drop. So you would put your target over here. Okay, next, let's look at the head and shoulders bottom. You know, this is just the opposite of the head and shoulders top, or it's also called, I believe, inverse head and shoulders. So, but it's basically the same thing. So it's basically identified when the price action of your security or your asset um price falls to the trough firstly and then falls below it. So it makes a lower low and lower highs, and then it rises again. And then it falls again, but not as far as the second trough. Once the final trough is made, which was basically the head, then price would hit upwards towards that resistance. Resistance here means this neckline level. So again, the neckline is when your swing high connects with your second swing high of the left shoulder and the right shoulder. So once that's made, once price has broken out that neckline, then you're going for a buy towards our target. Okay, so this pattern is quite recognizable as well to an experienced trader. So it's quite easy to use if you're able to recognize it. And also if there are very big market movements, you can time frame for the head towards your shoulder pattern is fairly long. So you can profit quite a bit if market moves significantly from your entry, which could be here, towards your target. Okay, so where would you place your stop in this case? Your target be here, you would place your stop somewhere below the neckline. So it still gives it some room to move around without you getting stopped out immediately if price does start to reverse. So it gives it some room to move or reverse back, and then it can still shoot up to your target. Okay, now we're looking at our double top. Again, double top formation patterns are quite easy to identify. You can see basically two triangle shapes. And these normally are they are bearish trend reversal pattern. So prices are moving in an uptrend, and once you see these formations, you're going for a sell towards a target that's somewhere below. The target, so the distance between where you enter versus your target profit should be about that same length or the same height as your triangle shape. Again, so that it gives it some room to breathe, some room to reverse and move around, but still make it to your target. Okay, so this is a very bearish technical reversal pattern because it basically shows that asset has reached this high price um, two times consecutively, but it has failed to move past that price. So it then shows a moderate decline. So yeah. So if you use this double top pattern with um a momentum pattern, so it could be maybe a MACD, it would be quite a bit more effective instead of just using a resistance level over here. Okay, so a double bottom, of course, would just be the opposite with prices moving in a downtrend and it tests this support level. It's unable to drop any further, so then it reverses twice consecutively and then moves upwards moderately towards this target. Again, your target level should be the height of your candlestick patterns. Okay, so one way to identify it and avoid any false signals is to look for that upswing, or in this case would be a downswing. So the price movement should be clearly indicated in a downtrend prior to the creation of this pattern. So this basically indicates that price has been making continuously lower lows and lower highs, which we see here. You can see this low is followed by a lower low. The high is followed by a lower high, or here as well. Okay, and then you want to make sure that you're able to find that initial trough. If we're looking at the double top, then your initial peak, um, because this would be the maximum level. So if price manages to break above it, that's not really a sign of a double top. So we find the trough again, and then your second peak price should more or less stop around that same level. Okay, it might even fall short of that first peak's height because price will kind of begin to collapse once more. Okay, and then once you draw this neckline, this dotted line, then you can go in for your sell or for your buy towards your target, which would again be that distance. Okay, okay, now let's look at our last pattern, which is your triple top. So this image is from Investopedia, but basically when you have a triple top, it's basically telling you that an asset is no longer rallying and that lower prices are on the way. So again, it's a bearish signal. So, okay, I guess the most significant shape here would be obviously the triple top. And then once price pulls back below that swing low, the two swing lows and the two troughs, then price breaks below the pullback lows, and then your pattern is complete. So if you're a trader, you would exit longs or enter shorts when the triple top completes over here. Once it breaks below this pullback low. Okay, so if you are going in for a sell, in this case, if you're looking at triple top, you'll be going for a sell. So from here, you're going for a sell, you can place your stop loss above that resistance level. So above this triple swing high over here. Okay, so those three consecutive peaks are very similar to that head and shoulders pattern that we looked earlier. But in this case, your middle peak should be nearly equal to the other heights, the other peaks, rather than being higher. So it's also similar to the previous double top pattern that we looked at when the price reaches your resistance area twice, creating a pair of high points before falling. Okay, so it's traded essentially in the same way as your head and shoulders pattern that we went through earlier. Okay, looking at our triple bottom, again, we have that same shape. You have three swing lows instead of swing highs in this case. But it's basically the same. Prices break out of this neckline, which again is the connecting line between your swing. Here would be swing highs. Between the swing highs, once price breaks out of that, then you can go in for a buy towards your take profit. In this case, your stop loss would be below your triple bottom. Okay, I think my camera froze there for a bit. Can you guys see me now? Okay. Okay, now let's look at the top three breakout chart patterns. Okay, firstly, we have the falling wedge. So we are going in for a target, in this case, that's at least the size of a chart pattern for wedges and rectangles. Okay, so we have the shape that we're looking for here, and here's an example of what the falling wedge pattern looks like on your charts. So basically starts off with a rising trend, followed by a downtrend or your correction, and then it breaks out of that. So we're expecting prices to break out of it here and head towards our take profit. Okay, so falling wedges are bullish signals. Okay, one of the most I guess the easiest way to identify these is by looking at your trend lines. So here we have 1, 2, 3 swing highs. Once you connect those levels, you form this descending trend line. And if you connect these two levels, you also be drawing your trend line, and you can kind of figure out this shape as kind of a converging, the trend lines are kind of converging on your price chart. So that's an easy way to identify your wedge. Okay, so quite obviously the lines show the highs and the lows are either rising or falling at different rates, so it gives the appearance of a wedge since both lines are kind of approaching a convergence. Okay, um, okay, let's look at our bullish rectangle. Can you guys still see my screen? My screen suddenly blacked out for a second. I'm not too sure what happened. Can you guys see me? Okay. Okay, good. Because my on my side my screen suddenly blacked out, so I'm not too sure what was happening there. But okay, getting back, we're looking at our bullish rectangle pattern. So basically what we are expecting here is prices are moving in an uptrend first. They're kind of moving sideways within this rectangular shape, and then we're expecting it to break out. So once it breaks out of this I guess trend line, once it breaks out of that, we have upside confirmation. The prices are going to continue upwards, and then we're going into for our take profit. Okay, so it's pretty straightforward. Basically consists of two parallel trend lines. So once you connect, again, for all these patterns, you're basically connecting the swing highs and the swing lows to form your pattern. So that makes it easier to spot any shapes as well. So your lower trend line acts as a support level, this one here, and your upper trend line here acts as a resistance level. Then these trend lines create kind of a rectangle shaped pattern. So this is what we call a consolidation phase. So during this pattern's formation, price moves sideways between the two trend lines. Okay, so yeah, this is called our consolidation period where neither your buyers or your sellers are in control and there's no real, I guess, trend. Okay, once the breakout happens, it actually breaks out above this entry and we're going for a buy towards our take profit there. Okay, next we have our bullish pennant pattern. So for a pennant pattern, we are looking for this kind of a shape here. Okay, so this occurs again after an uptrend. So you can see prices moving in uptrend here. And it indicates a potential continuation for upward movement. Okay, so this I think this bullish pennant name is also a flag shape, if I'm not wrong. Because this is commonly this line here, this shape is commonly referred to as a flagpole because it kind of resembles a flag shape. So once prices are moving in this bullish shape and it breaks out of this flag shape, then there is strong upward movement of the price of your security. Okay, again, the consolidation phase would be over here where there's no real trend, and the breakout from this consolidation period basically forms forms this triangle shape or like pennant shape, and then it'll happen upwards, so break above this trend line and hit towards our take profit. So you want to make sure that you don't place your stop loss too close to the bottom of your shape. Typically you place it below the first swing low, so it gives it room to breathe, so you don't get stopped out here. Okay. Okay, are there any questions so far? Okay, if not, let's move on to combine these patterns with what we've learned so that we get a better, higher probability breakout strategy. So if you guys have joined us for a while, you would know the support and resistance patterns that we use, the trend lines, oscillator indicators, and momentum indicators. Okay, but if not, I'll just briefly go through them right now. So earlier I mentioned support and resistance. Obviously, it's just the price at which an asset tends to stop falling, which will be your support, or stop rising, which is your resistance. Okay, and you use technical analysis tools like your trend lines, moving averages, chart patterns, so on and so forth. And we normally take note of these levels at your swing highs and swing lows. Okay, yep, so some things to take note of. Insignificant swings, you want to avoid using these levels as your support and resistance levels as well. Yep, here's another example. This is something that you should look out for. Significant moves up or down, obvious peaks and troughs, and clear market movement. Okay, another example here. So support and resistance levels obviously can be used as take profit and stop loss levels. However, using a recent swing high or low is a weak level if it's the only level. So that's why we mentioned using multiple swings, where at least two swing high or lows line up nicely, and it's a much better level to use. Okay, so some starting points. When picking your points, you want to make sure that there is a swing high or low, pullback or overlap level to start from. Go as far back as possible, and you want to make sure that you are just intersecting the wicks and not the bodies of the candlesticks. So for example here, you want to make sure there's a very clean cut of your candlesticks and you're not really doing this here where it's too messy. Okay, some more examples. Okay, now let's talk about the pullback and the overlap, support and resistance. Okay, because we've been mentioning pullback and overlap quite a bit in the previous slides. So if you're unfamiliar with what a pullback support is, it's basically a um when it breaks out. So you can see here, for example, in this GIF, price is at a swing low, okay, and price has broken below that level. So it's a pullback level because we are expecting price to revisit it over here. And once price has revisited it, it then becomes an overlap level where your swing high and your swing low line up. So the pullback is kind of the in-between level before it becomes an overlap. Okay, so here's an example. We have three swing lows, making it a support level. Once price breaks below it, it then becomes a pullback level, and we're expecting price to revisit it and reverse off of it again. If we're talking about the support, prices are moving, prices react off of this resistance level at first. And once price breaks out of it, then comes a pullback support, and we're expecting price to bounce off of that level. Okay, combining both, here's an example. Using a big swing high resistance, the moment price surpasses it, it becomes a pullback support, and price has made a pullback to our pullback support level and bounced off of it perfectly. And the moment price bounces off of it, it then becomes a overlap support. Okay. Yep, here's another example. So you can see price normally does come back to revisit it after, since we have price bouncing off of it again. Here as well. So we can combine these with trend lines as well. If you're able to spot any of the candlestick pattern formations that we mentioned earlier, especially if you link them up with any of the pullback and overlap levels that we've mentioned, that will really strengthen your analysis. Combining them with trend lines, of course, this only works in a trending chart. If not, you can also look at any patterns that we went through. Okay, and combining it with channels as well, resistance and Ichimoku, like we did earlier as well. Okay. Yeah, I think that's all I have for you guys for today. Are there any questions? Okay, if there are no questions, um, that's it for today. Thank you guys so much for joining me. I hope you guys found this session helpful, and I'll see you guys again next week. Thanks, everyone. Bye. Thanks, everybody. See you guys next week.